Current stock price, $117.17, as of May 17, 2025. Market cap, approximately $190 billion. PE ratio, approximately 26. Dividend yield. NAD Company Overview. Advanced Micro Devices Incorporated, AMD, is a leading semiconductor company specializing in high-performance computing, graphics, and visualization technologies. Headquartered in Santa Clara, California, AMD designs and manufactures microprocessors, graphics processors, and system-on-chip solutions for various markets, including data centers, gaming, and embedded systems. Financial performance. In the first quarter of 2025, AMD reported robust financial results, demonstrating strong growth across its core business segments. Revenue, $7.44 billion, a 36% increase year-over-year, driven by strong demand in the data center and client segments. Advanced Micro Devices Incorporated +4 The Motley Fool +4 Guru Focus +4 Net income, $709 million, up 476% from the previous year, reflecting improved operational efficiency and higher margin product sales. Market Screener +1 Advanced Micro Devices Incorporated +1 Earnings per share, EPS, 44 cents, GAAP, a significant increase from 7 cents in Q1 2024. Advanced Micro Devices Incorporated +1 Market Screener +1 Gross margin, 50%, GAAP, up from 47% in the same quarter last year, indicating improved profitability. Advanced Micro Devices Incorporated operating income, $806 million, a substantial increase from $36 million in Q1 2024. Advanced Micro Devices Incorporated. These results underscore AMD's strong financial health and its ability to capitalize on growing demand in key markets. Business segments. AMD's performance across its business segments in Q1 2025 was as follows: Data Center, revenue of $3.67 billion, a 57% increase year-over-year, driven by strong demand for EPS CPUs and Instinct GPUs. Guru Focus +2 The Motley Fool +2 ROIC AI +2 Client, revenue of $2.29 billion, up 68% year-over-year, fueled by robust sales of Ryzen processors. The Motley Fool Gaming, revenue of $0.64 billion, a 30% decrease year-over-year, primarily due to lower semi-custom sales. The Motley Fool +1 Guru Focus +1 Embedded, revenue of $0.82 billion, a 3% decrease year-over-year, with a gradual recovery expected in the second half of 2025. Guru Focus. The data center and client segments were the primary drivers of AMD's revenue growth, reflecting the company's strong position in high-performance computing markets. Nasdaq +2 Guru Focus +2 The Motley Fool +2 Strategic initiatives. AMD has undertaken several strategic initiatives to strengthen its market position and drive future growth. ZT Systems acquisition. In March 2025, AMD completed the acquisition of ZT Systems for $4.9 billion. ZT Systems is a leading provider of AI and general-purpose compute infrastructure, enabling AMD to offer end-to-end AI solutions for data centers. The Motley Fool AI Infrastructure Partnership. AMD announced a $10 billion partnership with Saudi Arabia's Oman to build a 500-megawatt AI computing infrastructure over 5 years. This collaboration positions AMD as a key player in the Middle East's growing AI ecosystem. Reuters +2 Baron S +2 The Times of India +2 Reuters stock buyback program. The company initiated a $6 billion stock buyback program, increasing its total share repurchase authorization to approximately $10 billion. This move reflects AMD's confidence in its financial strength and commitment to returning value to shareholders. The Times of India +2 Baron S +2 Reuters +2 Reuters. These initiatives demonstrate AMD's proactive approach to expanding its capabilities and market reach in the rapidly evolving semiconductor industry. Risks and challenges. Despite its strong performance, AMD faces several risks and challenges. Export restrictions. New export license requirements for MI308 shipments to China are expected to result in a $1.5 billion revenue reduction for the full year 2025. This regulatory hurdle may impact AMD's growth prospects in the Asian market. Guru Focus competitive pressure. The semiconductor industry is highly competitive, with major players like Nvidia and Intel vying for market share. AMD must continue to innovate and differentiate its products to maintain its competitive edge. Supply chain constraints. Global supply chain disruptions could affect AMD's ability to meet demand for its products, potentially impacting revenue and customer satisfaction. Addressing these challenges will be crucial for AMD to sustain its growth trajectory and market position. Market outlook. Analysts maintain a positive outlook on AMD's stock, citing its strong financial performance and strategic initiatives. The company's focus on high-growth areas such as AI and data centers positions it well for future success. However, potential regulatory challenges and competitive pressures warrant cautious optimism. In conclusion, AMD's robust financial results, strategic acquisitions, and expansion into AI infrastructure underscore its potential for sustained growth. Intel Corporation, INTC, Stock Analysis, Navigating Challenges and Strategic Shifts. Current stock price, $21.66, as of May 17, 2025. Market cap, approximately $90 billion. PE ratio, not applicable due to reported losses. Guru focused dividend yield, not applicable. Wikipedia company overview. Intel Corporation is a leading semiconductor company known for its microprocessors, integrated graphics chips, and other computing components. The company has been undergoing significant restructuring under its new CEO, Lip-Bu Tan, who assumed leadership in March 2025. Tan has initiated cost-cutting measures, including workforce reductions and a stricter return-to-office policy, to streamline operations and improve efficiency. The Motley Fool +4, The Verge +4, Financial Times +4, Financial Times +1, Investopedia +1. Financial performance. In the first quarter of 2025, Intel reported the following financial results: revenue, $12.7 billion, flat year-over-year and slightly above analyst expectations. Guru Focus +1, Financial Times +1. Net loss, $821 million, compared to a loss of $400 million in the same quarter last year. Financial Times adjusted EPS, 13 cents, surpassing the estimated loss of 22 cents per share. Guru Focus gross margin, 36.9%, down from 41.0% in Q1 2024. Investing.com +2, Guru Focus +2, Nasdaq +2. Operating expenses, reduced to $4.8 billion, down 19% from the previous year, reflecting the company's cost-saving initiatives. Guru Focus +1, Captide +1. Despite the net loss, Intel's adjusted earnings per share exceeded expectations, indicating progress in its restructuring efforts. Guru Focus business segment performance. Intel's performance varied across its business segments in Q1 2025. Client Computing Group, CCG, revenue of $7.6 billion, down 8% year-over-year, primarily due to declining PC demand and competitive pressures. Investing.com +2, Captide +2, Nasdaq +2. Data Center and AI, DCAI, revenue increased by 8% to $4.1 billion, driven by strong demand for AI-related server CPUs and storage solutions. Intel Foundry, revenue of $4.7 billion, up 7% year-over-year, despite an operating loss of $2.3 billion. Investing.com. All other segment, including Mobileye and Altera, revenue surged 47% to $943 million, with an operating profit of $103 million, compared to a loss in the same quarter last year. Market Screener +2, Captide +2, Investing.com +2. The TI segment showed promise, reflecting Intel's strategic focus on AI and data center markets. Market Screener +3, Investing.com +3, Nasdaq +3. Strategic initiatives. Under CEO Lip-Bu Tan's leadership, Intel is implementing several strategic initiatives: the Motley Fool +4, Financial Times +4, The Verge +4. Workforce reductions. Following the layoff of 15,000 employees in late 2024, Intel plans additional workforce reductions and a stricter return-to-office policy to improve efficiency and accelerate decision-making. Financial Times capital expenditure cuts. Intel has reduced its capital expenditures for 2025 by $2 billion, with anticipated spending between $8–11 billion, depending on future government funding from the CHIPS Act. Financial Times product development. Intel is focusing on developing AI-focused products, including the Panther Lake processors, which are scheduled for release by late 2025. Wikipedia +1, The Verge +1. These initiatives aim to streamline operations and position Intel for long-term growth in the semiconductor industry. Risks and challenges. Intel faces several risks and challenges. Trade policy uncertainty. The company anticipates a cost of a few $100 million in the second half of 2025 due to new tariffs expected to take effect during Q3. Competitive pressures. Intel continues to face intense competition from companies like TSMC and Nvidia in the semiconductor market. Operational challenges. The company is undergoing significant restructuring, which may impact short-term performance. Despite these challenges, Intel's strategic initiatives and focus on AI and data center markets position it for potential recovery. Market outlook. Analysts maintain a cautious outlook on Intel stock, citing the company's restructuring efforts and strategic focus on AI and data center markets. The anticipated release of the Panther Lake processors and ongoing cost-cutting measures may drive future growth. Wikipedia +1 The Motley Fool +1 In conclusion, Intel Corporation's recent financial performance reflects both challenges and strategic shifts aimed at long-term growth. Investors should monitor the company's progress in executing its restructuring initiatives and the impact of macroeconomic factors on its performance. Shopify, SHOP, Stock Analysis 2025, Building the Backbone of Global E-Commerce. Disclaimer: this article is for informational purposes only and should not be construed as financial advice. Please consult with a licensed financial advisor before making investment decisions. Pushpin emoji, company snapshot. Ticker, SHOP, NYSE, TSX Industry, E-Commerce, Cloud SaaS, FinTech founded, 2006 headquarters, Ottawa, Canada. Market cap, May 2025, $140 billion. Current share price, May 17, 2025, $110.75. Forward PE, 57. Dividend yield, 0%. Growth-oriented primary competitors, Amazon, BigCommerce, Wix, Squarespace, Adobe Commerce, Office Building emoji. Business model overview. Shopify offers a cloud-based, multi-channel commerce platform designed for small and medium-sized businesses, SMBs, and increasingly, enterprise merchants. Its software allows users to create and customize online stores, manage products, inventory, payments, and shipping, all under a single platform. The company earns revenue primarily through two segments: subscription solutions, monthly fees from access to its platform; merchant solutions, transaction fees, Shopify Payments, POS hardware, shipping services, and Shopify Capital. Shopify's platform powers over 2 million merchants globally, from small independent stores to global brands like Mattel, Glossier, and now Reebok and Barnes & Noble, part of its push into the enterprise tier. Bar chart emoji, financial performance. Q1 2025. Shopify's first quarter results showed strong revenue growth and solid profitability despite global macro pressures and a slowing e-commerce environment. Q1 2025 highlights: revenue, $2.36 billion, plus 27% year. Adjusted EPS, 25 cents, missed by 1 cent versus expectations. Gross merchandise volume, GMV, $74.75 billion, plus 22.8% year. Free cash flow, $363 million, 15% margin. Operating income, $203 million, versus $86 million in Q1 2024. These figures illustrate Shopify's ability to maintain momentum post-COVID era e-commerce surges, delivering both top-line growth and operational efficiency. Revenue breakdown: subscription revenue, $490 million, plus 22% year. Merchant services revenue, $1.87 billion, plus 29% year. Merchant services now make up 79% of Shopify's total revenue, showcasing the platform's ability to extract more value per merchant via payments, fulfillment, and financial services. Rocket emoji, growth drivers. 1. Enterprise expansion. Historically SMB focused, Shopify is pivoting to enterprise. The launch of Commerce Components, a modular platform for large retailers, has led to wins with Reebok, Staples Canada, Overstock.com, Barnes & Noble. Its enterprise segment diversifies Shopify's revenue base and positions it in the same league as Adobe Commerce and Salesforce Commerce Cloud. 2. AI and automation. Shopify is embedding AI-powered tools into merchant dashboards, improving inventory forecasting, dynamic pricing, chat-based customer support, and ad targeting. This adds defensibility and stickiness to its ecosystem. Recent tools include Shopify Magic, natural language AI for content generation; Sidekick, AI assistant for business operations. 3. Logistics and fulfillment. Though Shopify sold off parts of its fulfillment network in 2023, it still offers warehousing and delivery through third-party integrations and remains focused on first-mile to doorstep efficiency. With Amazon stepping up with Prime, Shopify's challenge is to enable fast, affordable shipping without vertically integrating. 4. Fintech monetization. Shopify Payments, Capital, and Installments now handle billions in volume. Platform acts like a de facto neobank for merchants. Shopify Payments powers 55% of GMV. Shopify Capital, over $5 billion in funding distributed to merchants since inception. Shopify Balance, digital business banking with zero fees, launched to great uptake. Fintech continues to be a high-margin growth area. Microscope emoji, key metrics and operating trends. Metric Q1 2025 year growth revenue $2.36 billion plus 27%, adjusted EPS 25 cents minus 4%, free cash flow margin 15%, steady gross margin 49% plus 50 basis points, GMV $74.75 billion plus 22.8%, merchant count 2.1 M plus 12%, while earnings missed slightly due to investment ramp-ups. Shopify's cash flow, GMV growth, and margin expansion show operational strength. Jigsaw emoji, strategic partnerships and acquisitions. Collaboration with Meta, Instagram, Facebook Shops, seamless social commerce integration. Google and YouTube commerce integrations, driving organic discovery and sales. With Prime integration ban reversal, Shopify now allows merchant choice, reflecting a maturing, less protectionist platform approach. Debt acquisition, 2024, an AI-based product recommendation startup integrated into Shopify Magic. Chart with downwards trend emoji, risks and headwinds. Despite Shopify's bullish trajectory, investors must consider the following risks. 1. Macro sensitivity is a proxy for e-commerce activity. Shopify's performance is tied to consumer spending and inflation trends. If global retail spending slows, GMV will likely follow. 2. Valuation risk. Trading at 57x forward earnings, Shopify is priced for growth. Any missteps on margins or user growth can result in outsized stock corrections. 3. De minimis tariff rule. The US may eliminate the de minimis exemption for imports under $800, potentially increasing costs for dropshippers on Shopify using Chinese goods. This poses risks to a large merchant segment. 4. Competitive pressure. Amazon's expanding marketplace, Wix's ease of use, and Adobe Commerce's enterprise tools are formidable. Shopify must continue to evolve quickly. Brain emoji, management and leadership. Shopify is led by CEO Harley Finkelstein, who took over from co-founder Toby Luke. Finkelstein brings product vision and merchant empathy, while Luke remains executive chair and key product voice. Under their leadership, Shopify has made strategic cost cuts post-pandemic, refocused on core e-commerce strengths, emphasized long-term merchant empowerment over aggressive vertical integration. Investor sentiment remains largely positive around Shopify's leadership team. Stock performance and analyst sentiment. Firm rating. Price target, 12-month Morgan Stanley overweight $1,000, UBS by $980, Bank of America Merrill Lynch by $1,050, RBC Capital Markets outperform $995 with a consensus 12-month target range between $950 and $1,050. Split adjusted, analysts see significant upside potential if Shopify executes its enterprise and AI strategy. Compass emoji, long-term outlook, 2025 to 2030. Shopify is evolving from a high-growth SaaS platform into a multi-pronged fintech, commerce infrastructure, and enterprise provider. Key long-term catalysts include scaling large enterprise clients, monetizing AI-driven merchant tools, expanding Shopify Payments and Capital globally, enabling omni-channel retail through POS and B2B by 2030. Shopify aims to power 10% plus of global e-commerce, up from an estimated 5% today. With a TAM exceeding $10 trillion, the opportunity is vast. White tick mark emoji, conclusion, is Shopify stock a buy in 2025? Shopify's Q1 2025 results reinforce its place as the infrastructure layer for e-commerce. With impressive GMV growth, expanding enterprise offerings, and consistent cash flow, Shopify remains one of the best-positioned growth stocks in the digital commerce space. Bull case, Shopify becomes the Salesforce of commerce with sustainable profits, AI-led efficiencies, and a vast merchant base. Bear case, growth slows post-pandemic, Amazon pressures Shopify's logistics vision, and valuation multiples compress. Bottom line, Shopify is a high-growth tech stock with long-term upside potential. While not without risk, its multi-segment business model and product-led innovation suggest a bright future. Baker Hughes Company, BKR, Stock Analysis 2025, Innovating Through the Energy Transition. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a qualified financial advisor before making any investment decisions. Overview of Baker Hughes, BKR ticker, BKR Exchange, NYSE Industry, Energy Technology and Oilfield Services Market Cap, May 2025, $36 billion Stock Price, May 2025, $36.50 P/E Ratio, Forward, 17.5x Dividend Yield, 2.3% Headquarters, Houston, Texas. Baker Hughes is one of the largest global providers of oilfield services, industrial energy technology, and digital solutions. Originally founded in 1907, the company today operates in more than 120 countries, offering products and services that span from upstream exploration to downstream processing and digital optimization. As the energy industry undergoes a massive transformation, driven by decarbonization, digitalization, and geopolitical realignment, Baker Hughes aims to redefine itself as a technology-forward, diversified energy company. From building liquefied natural gas, LNG, infrastructure to integrating artificial intelligence into its service platforms, BKR is evolving beyond traditional oilfield operations. Recent financial performance: Baker Hughes reported Q1 2025 earnings that, while mixed, offered several key takeaways on the health of the business. Q1 2025 highlights: revenue, $6.4 billion, missed estimates by $90 million, adjusted EPS, 51 cents, beat consensus by 3 cents. Net income, $402 million, down 12%. YoY free cash flow, $454 million, down 10%. YoY adjusted EBITDA, $1.04 billion, up 10%. YoY order backlog, $6.5 billion. Despite a revenue miss, Baker Hughes posted stronger than expected earnings thanks to solid cost discipline and improved margins, particularly in its industrial and energy technology (IET) segment. The EBITDA growth was encouraging, reflecting productivity gains and cost restructuring that continue to support profitability. Free cash flow declined slightly year-over-year, reflecting elevated capex and strategic investments in digital infrastructure. Business segments and growth engines: Baker Hughes operates through two primary segments. 1. Oilfield Services and Equipment, OFSE. This is Baker Hughes' traditional core business, offering tools and services for drilling, well completion, pressure pumping, and artificial lift systems. Though mature, it remains the company's revenue backbone. Key trends: OFS accounts for 55% of revenue. Recovering rig counts in the Middle East and Latin America. Flat to slightly declining activity in North America due to shale slowdown. Digital twin technologies are enhancing upstream efficiency. 2. Industrial and energy technology, IET. This is the growth engine. Yet includes turbo machinery and process solutions, gas tech and LNG systems, carbon capture, hydrogen, and renewables, AI and digital services. Notable drivers: global LNG infrastructure boom, US, Qatar, and West Africa. New contracts from Qatar Energy, Venture Global. 12% YoY increase in gas technology sales. AI-based diagnostics and analytics via Baker Hughes. 3.I Baker Hughes has correctly identified the multi-decade opportunity in gas and low-carbon technology, positioning yet as a platform for long-term secular growth. Strategic initiatives. 1. Clean energy transition. BKR is investing in decarbonization with initiatives in carbon capture, utilization and storage, CCUS, green and blue hydrogen, advanced geothermal systems. These sectors are early stage but could prove transformative. Baker Hughes is a founding partner in multiple CAS hubs across North America and Europe. 2. LNG and gas tech expansion with natural gas seen as a bridge fuel for the energy transition. LNG infrastructure is booming. Baker Hughes supplies compressors, turbines, and engineering services to large projects. Recent wins: Venture Global's Calcasieu Pass expansion, Qatar Energy's North Field East LNG megaproject, Angola and Mozambique field developments. 3. Digital transformation through its BHC3.ai joint platform. With C3.ai and Microsoft Azure, BKR delivers predictive maintenance tools, asset performance management, APM emissions tracking, AI-enhanced supply chain forecasting. These services enhance recurring revenues and improve operating margins. Competitive positioning: Baker Hughes competes against Schlumberger, SLB Halliburton, HAL Technip FMC, FTI Honeywell, HON, in some industrial tech areas. Strengths: diverse global customer base, strong R&D pipeline, broadest LNG compressor offering globally, deep relationships with national oil companies. Knox challenges: lower pricing power versus SLB in key markets. Transitioning identity may confuse investors. Short-term complex supply chain sensitive to geopolitical risks. Stock valuation and analyst sentiment: as of mid-May 2025, BKR trades at around $36.50 per share, with a forward PE of 17.5 and a forward EV/EBITDA of 8.5x. This is relatively attractive compared to peers, especially considering the company's exposure to secular energy infrastructure growth. Analyst price targets: Morgan Stanley, $50, overweight Barclays, $48, by RBC Capital, $50, down from $53, outperform average target, $48.53, 33% upside from current levels. Sentiment is generally bullish, with analysts citing strength in LNG and digital, though near-term caution remains due to oil price volatility and trade uncertainty. Dividends and shareholder returns: quarterly dividend, $0.21/share, 2.3% annual yield payout ratio, 40% of earnings. Buybacks: management has paused repurchases in favor of strategic capex. Dividend is sustainable, with upside potential if free cash flow accelerates in the back half of the year. Risks to consider: every stock carries risk, and Baker Hughes is no exception. 1. Energy price volatility: as a supplier to oil and gas operators, demand for BKR's services is indirectly tied to commodity prices. Although gas demand is structurally rising, oil price downturns can delay projects. 2. Tariff impact and trade wars: recent reinstatement of 10% tariffs on most Chinese imports could impact Baker Hughes' equipment supply chain. This may raise costs or cause project delays. 3. Transition execution: BKR is repositioning from a pure-play oilfield services firm to a diversified energy tech company. The transition could face hurdles in investor perception, capital allocation, and long-cycle project payback. 4. Geopolitical risks: operating in over 120 countries, BKR is exposed to Middle East tensions, African infrastructure delays, Russian sanctions, spillovers. Long-term outlook: 2025 to 2030. Baker Hughes has positioned itself for a pivotal role in the new energy economy. By leveraging its expertise in turbomachinery, industrial process automation, and software, the company is more than just an oilfield contractor. Bullish case: LNG and gas continue their global rise, gas and hydrogen emerge as viable commercial solutions. AI-based platforms create sticky recurring revenue. EBITDA margins expand to 18% plus. In this scenario, Baker Hughes could see its stock trade closer to $60-$65 over the next 3 to 5 years. Bearish case: oil prices fall below $60 for prolonged periods. Energy transition projects face funding shortfalls. Competition erodes margins in digital services. Execution delays stall yet growth here. BKR could stagnate in the $30-$35 range, underperforming peers focused on pure oilfield growth. Conclusion: is Baker Hughes, BKR, a buy in 2025? Baker Hughes is at the intersection of legacy energy and future technology. It's balancing the cash flows of oilfield services with the growth potential of LNG, AI, and decarbonization. While risks exist, especially around energy prices and global trade, the strategic transformation is gaining traction. Why BKR merits attention: strong order pipeline and recurring revenues leading LNG and gas tech exposure real progress in CAS, hydrogen, and industrial digitalization reasonable valuation with a solid dividend final take, for investors seeking exposure to the energy transition without abandoning traditional energy earnings, Baker Hughes presents a compelling hybrid play. Again, this analysis is for informational purposes only. Always consult with a licensed financial advisor before making investment decisions.